Hi guys, I want to talk a bit about my new holding, LandBridge. It's basically a landowner uh, that has a lot of diversified revenue streams. Uh, so they have like about 92% that are non-oil based, up from 88% the quarter before. So they're actually in decreasing the amount they rely on oil, if that makes sense. And the thing LandBridge does that is very successful as a business model is they enter into agreements where all the customers bear the risk and responsibility for operating and uh, having the high capex spend. Like they basically take all the expensive expenditures related to the operations of oil pumping and so on. So LandBridge is very efficiently run because of it, because their customers takes all the risks and they take all the profit. Sounds very good, right? So they have very nice EBITDA margins, robust cash flow, and they have very limited capex. They have a bit, but very limited. So they rely on oil, water handling infrastructure, uh, something in the area that is called Delaware Basin. Anyways, that's not really that interesting, but they have pipelines and they have basically capacity to generate about 30 million a year of cash flow uh, when that is fully built out. So they have somewhat of a economical moat because their customer takes on all this risk and they take on all the costs. So they have that part of the business that is very strong. On top of that, they have a potential to scale as well because they have they can produce more barrels per day and generate more profits per year, especially on the water part of the business. But something that I want to go over for 2027 with this company, if we actually look here, if we don't look at adjusted and we go to diluted earnings, we can see an explosive expected earnings growth. Basically, they're expecting 269% this year, 83% the year after, and 221% 2027. It's just analysts and so on, but this is because they're moving into having data center infrastructure on their land, where the customer pays for everything, of course. They don't want to pay for their capex, so to say. They just have the land and they have the water that is needed to cool these big centers, and they have cheap electricity in the way of gas. Yeah, so they can produce electricity that way. So they have a good, how do you say, not community, but a good area to build that infrastructure on, and that's going to affect their future results, so to say. But if we go to adjusted, it looks about fairly valued, just looking at the adjusted earnings. But like I said, I'm more into what this future looks like with the data centers and how much cash flow it will generate. And if we look like they're gonna have a decline, but it's 38, 24, so say 20%. But if we put this in a long term, let's say a long term view, you see they put 63. No, no, no. That's too low. Can I adjust that? No, that's just. Anyways, a long term view, 20%, you're basically making a decent amount of money. But today it's a bit not pricey, but it's fair. I would say it's a fair price you're paying today. So I didn't make a big position. I just bought 2 shares. So I'm hoping to get it cheaper. Not guaranteed to get it cheaper though. So, but I'm watching for a breakout. If it breaks up about this, I would probably add more, and then if it breaks below, I would probably add more around 41. So yeah, you get my thoughts about that. But the long term, I'm interested in the long term compounding on this company. Uh, if we look at the business, it's a growing the return on capital is growing, return on equity is growing. So I believe this will be in 2027, these numbers will be higher, and they will have a lot of cash flow. As I said, all the capex ends up on the customer, so they have very little uh, like the expenses are, yeah, where is the expensive, you see property expenses, okay, other operating expenses is 1.2 million of 47 million revenue, and they're growing. Yeah, you see the revenue is growing steadily, nicely up by 80%. Okay, that's maybe not expect 80% revenue growth yearly, but maybe above 50% for 4 years, 5 years into the future. But I see this company as a potential long-term compounder because of the way their company is structured, where they don't really take a lot of risk. Uh, like they're risk adverse. Do you say it like that? Yeah. They don't have a lot, like total operating expenses. They had the spike here. I don't know why, but like on average, it's about 20 million, below 20 million, and it's not really going up. It's just like this is what it costs to run everything, and the revenue keeps on growing. So the gaps is increasing with time, and of course, the bigger the gap, the more money will be left over, and eventually it will pay off to the shareholders. Basically, like when this company starts buying back shares, I think it will be a massive, how do you say it, like a massive incentive for shareholders. But like you see, operating here, you get a bit better view of it. It's like 56. They had a couple of quarters where it's a bit jumpy, but yeah, you get the idea. So you kind of understand how I'm thinking here. Like I'm thinking long term. This will be total expenses quarter for quarter looks more stable around 20, but yearly it's up and down. But yeah. Anyways, I think this is gonna be a low operating expense and a high revenue, total revenue over time. And the longer you hold it, the more upside you basically get. It's like a simple investment in this case. It's a bit more speculative because what if the customers leave? Yeah, that's the risk. Like if oil crashes and this oil becomes worthless, they lose a bit of revenue or something like that. But I think these data centers will be a massive upside. long term for this company. So they have quite strong financial performance, I would say. They basically grow their revenue every year, like over 50% the last years. And I think this will continue. And yeah, in the future, I believe the earnings will grow faster to catch up, basically, as expenses are very low. Yeah, I like a business where the customers bear all the responsibility for the operations, and basically the company own gets all the money, and in the future you get that money. So yeah, it's quite a simple investment, really. uh, I hope you enjoy this. This is my new buy. Yeah, I'll probably increase it over time if it becomes cheaper. I would like to see it at like 5% of my portfolio, maybe, because it's very simple. But the only one, I would say, risk is the zone they're in, because they're in this Delaware basin. Uh, s- so they're very dependent on the region, that there's no downturns, especially in that region, or regulations. So that could be something for the future that could be a worry. But I just I see this as a good opportunity to compound. It's very similar to the company. Actually, if you look TPL, I owned TPL before, and I did a lot. I did a lot. I did a lot. I got a lot for owning Texas Pacific Land Corp. Eh, okay, this doesn't work for some reason. Performance, historical, yeah. Yeah, I bought somewhere here in the 150 range, and basically it shot up and I sold. But it has kept on climbing, and it's still overvalued in my opinion. But there will come a time when oil will decline. Like, if I could get TPL at a cheap price, I would probably buy some TPL. It's also a nice compounder, but it's basically very similar to each other. They are basically very similar to each other. Um, so yeah, oh, maybe we should check. Actually, can we see anything? Not TPL, LandBridge. Can we see something? Yeah. Oh, yeah. I forgot to mention they're quite recently IPO'd. So they actually, all of them bought in July 2024. Was that when they IPO'd? Mm, when did they IPO? They IPO'd in, yeah, okay, so I think that's linked to the IPO. Um, but if we look at what they actually own, like total, they own about like the insider totally owns about 0.5%. So it's not really that heavy insider ownership. Um, about 7.8 million. So to say, out of, what is the market cap today? This is because I'm in Sweden, so it's almost 4 billion, and they hold about 8 million in insider ownership. Uh, but yeah, I'm pretty confident in the future of this company, and I understand the risks in holding it. So that's why I like this company. Mm. Yeah. and I like the operational efficiency of, yeah, basically the customers have to do all the work. I like that. So yeah, leave a thumbs up. Bye.